It's been a few days off on the markets after the long weekend, so we'll be playing catch-up this morning. Tom Piotrowski, good morning to you. So where are we going to land in the early parts?
Oh, Pete, we're going to kick off just in negative territory, not with any sort of conviction. The SPI futures are pointing to a loss of about 3 points at the moment. So one of the factors that is top of mind for Northern Hemisphere investors, or indeed globally at the moment, are the looming trade talks that will take place between the Chinese and US leaderships. This is going to happen in London, and there's some optimism that there'll be some progress made, but that's only been reflected very modestly in US markets as they closed overnight. So technology stocks did a little bit better. We saw a moderation in long-term interest rates, so the Nasdaq up by 1/3%, but the S&P 500 was just in positive territory and the Dow Jones was flat. So there is a lot to keep investors on the sidelines at the moment, Pete, until we get those key outcomes out of the way, which include the trade talks, but aren't limited to that. We've got a lot of inflation figures coming out of the US, particularly in the next couple of days. And then importantly, you might recall a couple of weeks ago, there was some hyperventilation about the moves in long-term interest rate markets. So interestingly, this week we have the US Treasury auctioning just north of $20 billion worth of 30-year government bonds. So that's significant because we don't talk about 30-year government bonds very much, but they've been moving aggressively higher from time to time, and equity investors have been concerned about whether or not borrowers are going to turn up. Lenders are going to turn up in terms of supporting these auctions. So that is quite an important outcome. The futures, as I said, pointing to a slightly weaker open to the Aussie market today, and the Aussie dollar, strangely enough, trading just north of 65 US cents, benefiting from some weakness in the US dollar at the moment.
Okay, Tom, thank you.